Imagine being the golden boy of crypto. Billion-dollar valuations, Super Bowl commercials, celebrities, politicians, and the media treating you like the next Steve Jobs. Now imagine it was all a lie. I've seen it all. For nearly 25 years, I worked at the DOJ, where I investigated some of the largest antitrust cases in the country. Now in retirement, I'm working for you. Welcome to the Antitrust Insider. This is the rise and catastrophic fall of FTX, a crypto exchange once valued at $32 billion, and how its boy genius founder, Sam Bankman-Fried, turned customer deposits into his personal piggy bank. Let's break down what really happened, because this wasn't just a crypto meltdown, this was fraud. Segment 1, the FTX Story, Origins of a Crypto Kingpin. In 2017, Sam Bankman-Fried, better known as SBF, was not a household name. He was a 25-year-old MIT grad, the son of two Stanford law professors. He'd worked a few years at the trading firm Jane Street Capital, a highly quantitative Wall Street shop where he honed skills in arbitrage trading, buying low in one market, selling high in another. But Sam wasn't interested in traditional finance. He was drawn to crypto, and he saw something others didn't. In late 2017, he realized that Bitcoin was trading at different prices in different countries. For example, in Japan, Bitcoin often traded 10% higher than in the US, sometimes more. So Sam launched a small crypto trading firm he called Alameda Research. Its mission? Arbitrage crypto prices across borders. He raised some money from friends and family and began moving tens of millions of dollars a day across exchanges, making risk-free profits. That's the origin story, but here's the first red flag. From the very beginning, Alameda wasn't a hedge fund in a traditional sense. It didn't have audited financials, it had weak controls, and it was run mostly by 20-somethings, many of whom lived together in a luxury penthouse in the Bahamas. Still, the money flowed in. By 2019, Sam wanted more than just a trading firm. He wanted a piece of the infrastructure, an exchange. Enter FTX. FTX was founded in 2019 as a crypto exchange built by traders for traders. It promised faster transactions, better risk controls, and innovative features like tokenized stocks and prediction markets. Sam presented himself as a genius innovator with scruffy hair, cargo shorts, and a nerdy charisma to match. By 2021, FTX had raised over $2 billion from investors, including Sequoia Capital, SoftBank, BlackRock, and Tiger Global. FTX's valuation exploded. In 2020, FTX was valued at $1.2 billion. In 2021, that number rose to $18 billion. And finally, in early 2022, FTX was valued at $32 billion. Sam was everywhere. He testified before Congress, he appeared in Fortune and Forbes as a benevolent billionaire, and he pledged to give away his fortune as part of the effective altruism movement. He spent hundreds of millions on sponsorships, did commercials with Tom Brady, Gisele Bündchen, and Larry David, made political donations totaling over $70 million in 2022 alone, and the mainstream media hyped him as the most trusted man in crypto. But behind the scenes, the line between FTX and Alameda Research was blurry, if not completely erased. Alameda wasn't just a customer on the FTX exchange, it was FTX's sister company trading with privileged access, and it was losing money fast. Segment 2, the collapse, how it all fell apart. It all started to unravel in early November 2022. A leaked balance sheet from Alameda Research obtained by CoinDesk showed something disturbing. Alameda wasn't sitting on blue-chip assets or stable investments. Most of its $14.6 billion in assets were in FTT, a token created by FTX itself. Think about that. Alameda's balance sheet was propped up by a token that had no intrinsic value outside of the FTX ecosystem. It was like if a casino gave you chips and then used those chips to convince a bank that it was solvent.
Fascinating.
The market panicked. Changpeng Zhao, the CEO of Binance and a one-time investor in FTX, publicly announced that he was selling $500 million worth of FTT tokens. That set off a classic run on the bank. FTX customers began to withdraw funds in droves. Within 72 hours, over $6 billion had been withdrawn. FTX froze withdrawals, and then it collapsed. By November 11, 2022, FTX and Alameda Research filed for bankruptcy. John J. Ray III, the same attorney who handled Enron's liquidation, was brought in as CEO of the bankrupt entity, and his initial statement said it all. "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information." What Ray and his team discovered was jaw-dropping. FTX wasn't just poorly managed, it was looting customer funds. Alameda had a secret backdoor in FTX's codebase, allegedly written by SBF himself, that let it borrow unlimited funds without triggering risk controls or collateral requirements. In total, over $8 billion in customer deposits had been siphoned off. So where did it go? First, political donations, and to both major U.S. parties, Republicans and Democrats.
Even more fascinating.
Some of the money also went to real estate in the Bahamas, celebrity endorsements, luxury expenses, and most notably, to cover Alameda's reckless trades and margin calls. The king of crypto was now under federal investigation. By December 2022, Sam Bankman-Fried was arrested in the Bahamas at the request of the U.S. government. In March 2023, his top lieutenants, Caroline Edison, CEO of Alameda, and Gary Wang, co-founder of FTX, pleaded guilty and cooperated with prosecutors. Their testimony confirmed what many had already suspected. Sam was calling the shots. He knew exactly what was happening, and he was the one who ordered the misuse of customer funds. In November 2023, Sam was convicted on 7 counts of fraud and conspiracy. The jury deliberated for just 4 hours, and in March 2024, he was sentenced to 25 years in federal prison. The total losses were between $8 billion and $10 billion, though the collapse vaporized much more in crypto market value. Segment 3, Lessons Learned and the Warning Signs. First, the cult of personality can blind even the smartest investors. People wanted to believe SBF was a genius, a visionary too brilliant to fail. They ignored the red flags, conflicts of interest, phantom audits, and financial shell games because they were seduced by the myth. But ultimately, no amount of hype can turn fraud into innovation. Crypto's volatility doesn't justify fraud. What happened at FTX wasn't just a market crash or bad luck, it was outright theft. This wasn't about Bitcoin's price swings, it was about deception, mismanagement, and blatant disregard for the law. The collapse wasn't inevitable, it was criminal. Regulation matters. FTX was based in the Bahamas, far from the reach of US regulators. It used that freedom to run a shadowy, interconnected network of entities with no oversight. The SEC and CFTC are now scrambling to catch up, but it's too little too late for those billions lost. There's always a too good to be true component to fraud. Always. If someone promises safe returns in an unregulated space, be skeptical. FTX claimed to be safe, secure, and sophisticated, but behind the scenes, it was essentially playing with monopoly money. I've said it before, and I'll say it again. Transparency is everything. Unlike traditional finance, crypto offers an opportunity to build systems that are more transparent. But FTX used that technology to obscure, not to illuminate. We need to hold platforms accountable to basic rules of honesty and disclosure. The collapse of FTX wasn't just a crypto scandal, it was a modern-day Ponzi scheme disguised with code and charisma. Sam Bankman-Fried's story is a cautionary tale, not just about greed, but about how power, narrative, and lack of oversight can lead even the smartest minds to make catastrophic decisions. And we all need to pay closer attention because the next fraud won't look exactly like this one, but it will rely on the same tricks: hype, secrecy, and misplaced trust. If you found this video helpful and informative, please hit that subscribe button, like, and comment. Until next time, stay vigilant, stay honest, and come back for more Antitrust Insider.